traders are using supply and demand completely wrong. It doesn't matter if you trade pure price action, ICT, SMC, or anything else. If you can't identify high quality institutional zones, you are trading blind. What if I told you one of the greatest investors of all time has been showing us exactly how these zones work for decades? In this video, I'm going to show you real examples of how Warren Buffett and other institutions operate with supply and demand. You'll see how these zones form, how to identify the ones that actually matter, and how to use weekly institutional positioning to your advantage. So you can stop guessing and start trading in line with smart money. And if you find value in this, please like and subscribe. It really helps me to continue making this type of content. Now let's get into it. I'm sure everyone knows who this is. Warren Buffett, one of the greatest investors of all time. In 2011, during the European debt crisis, Bank of America was under enormous pressure. The stock had been absolutely crushed. But then something interesting happened. This area became one of the strongest demand zones you will ever see. Why? Because Warren Buffett stepped in and invested $5 billion into Bank of America. And that is not a small position. That is a massive commitment. And think about this for a second. When you are investing billions of dollars, you can't simply buy everything at one price. You need liquidity. You need sellers willing to sell. Now let's look at this on the weekly chart. After the initial rally, price returned to this area multiple times. And every time it did, buyers appeared, demand kept getting defended. Now let me ask you a very important question. Do you think Warren Buffett wanted to buy after price had already gone up? Or do you think he preferred buying when price had already came back into an area he considered value? You know the answer. He waited. This is supply and demand in the real world. Institutions don't chase price. They wait for price to come back to areas where demand already exists. Sometimes they are the reason that demand exists in the first place. Now, this is Boyd Gaming Corporation. During the financial crisis, the stock was absolutely crushed. But in 2009, Warren Buffett invested heavily into the company. And look at this area on the chart. This became a major demand zone. And what's fascinating is what happens afterwards. Years later, price returned to this exact same area. Not once, but twice. And both times, buyers stepped in aggressively. Now look at those reactions and look at those rejections. Look at the momentum that followed. This is one of the reasons supply and demand can be so powerful. Large institutional buying can leave footprints on a chart. And sometimes those footprints remain important long after the original event itself. The lesson here isn't that Warren Buffett was still buying years later. The lesson is that areas where significant buying once occurred often continue attracting buyers in the future. That's why I always pay attention to these zones. Now, before I show you how to use institutional positioning alongside supply and demand, I want to introduce you to two traders, Bernd Skorupinski and Larry Williams. Now, Bernd is widely regarded as one of the most successful prop firm traders of all time. Larry Williams holds one of the most famous records in trading history after turning $10,000 into more than $1 million in a single Robbins Cup competition. And his daughter even made third on the list 10 years later. Different generations, different styles, different trading journeys, but both place enormous importance on COT data. the Commitment of Traders report, a report released every Friday showing how large commercial institutions are positioned. So before we go any further, understand this. This isn't my idea. This isn't some indicator. This is information used by traders who have achieved results most people can only dream about. So if you want to see how institutional positioning can help identify high quality supply and demand zones, keep watching, because this next section might completely change how you look at the market. Now let's start with the Australian dollar futures market. This is the Commitment of Traders report. And for this video, I only want you to focus on one group, the commercials. These are some of the largest participants in the market. And historically speaking, they tend to build positions near major turning points. Now, let's take a look at what happened in May. Commercials were sitting in bearish extremes, and they had been building those positions for quite some time. But does that mean I immediately sell? Absolutely not. Positioning tells me where to focus. Price tells me where to act. So the next question becomes, where would I want to see selling pressure appear? It's a monthly supply zone. Now watch what happens on the daily time frame when price comes back into this area. Price reaches the monthly supply, but despite multiple attempts, buyers cannot establish themselves inside the zone. In fact, price fails to produce a single daily close inside that supply area. That tells me something important. Sellers are still defending the zone. But once price starts moving away from the area, the market gives us our answer. And commercial positioning and price action were telling the same story. And price moves aggressively lower. Now let's take a look at Euro futures market. Back in February, commercials reached bearish extremes. Now at the same time, a strong weekly supply zone was created. Remember the examples I showed you earlier with Warren Buffett? When institutions build large positions, they don't always get everything filled at once. The question I'm asking isn't whether I should short immediately. The question I'm asking is, what happens if price comes back to an area where these institutions may still be interested in selling? And you can see what happens. You have a sharp rejection and price moves aggressively to the downside. When you combine COT data to supply and demand, you are going to get these same setups over and over again. Now, you might be wondering, how do I actually use all this information? The answer is pretty simple. Start looking at it yourself. This is the COT report, and the good news is the data is completely free. For today's video, I only focused on one group, the commercials. Because if you are new to COT data, that's where I'd recommend starting. And yes, there are other groups, and yes, there is much more we can discuss. But first, learn to understand what the commercials are doing. Now remember, two traders who have achieved amazing results in the market, they have different personalities, different approaches, but both place enormous importance on COT data. That doesn't mean you should blindly follow it, and it doesn't mean every trade will work. But if traders operating at that level consider this information important, maybe it's worth paying attention to. So start studying it and start comparing positioning to price, and start asking yourself one simple question. What are institutions doing here? Because the better you become at answering that question, the more sense the market starts to make. And if you have any questions, leave them in the comments. I read every single one and I will get back to you. And I will see you in the next one.